Hey there, today on Behind the Charts, we're hearing from Steve Suttmeier. Steve runs the Technical Research Department at Bank of America in New York, Bank of America Securities, formerly the Merrill Lynch Technical Research Shop, which is one of the largest, longest running technical research shops on Wall Street. So it was really cool to sit down with Steve. Steve comes from sort of a family of technicians. His father, Rich Suttmeier, was a trader, a bond trader, and an avid technical analyst of his own right. So Steve comes by it honestly. He writes a monthly packet that I consumed in my former role at a large buy-side shop, which I always thought was a great way to visually understand how the markets were evolving month to month. So we talked a little bit about how his process, how he puts together that monthly packet and what it means for him. He has a background in fixed income and in fundamental analysis, which is a little unusual. A lot of technical analysts come from more of a futures, commodities, or equities background. I think his background in fixed income puts him very well positioned to think more about the risk side of the equation, which can be really helpful for individual investors. So here's my conversation with Steve Suttmeier from BofA.
So folks, we're here with Steve Suttmeier. He's the Chief Equity Technical Strategist at BofA Securities here in New York. Steve, good to see you, my friend.
Yep, good to see you, Dave.
So for those of you, or for those of our listeners that are not familiar with your work and your background, can you just give us a brief history? How did you get to this point, running, one of the famous technical research shops on the street, to be honest with you? How did you get to this point?
Yeah, it's a long story. I mean, my dad was in the industry. So
that's right.
That was helpful.
Yeah.
He had a newsletter focusing more on fixed income. I worked with him for a while.
Okay.
Moved out on my own, did research at a small shop called William R. Huff in Florida. So I was a hybrid technical fundamental strategist.
Right.
So I got the CFA, or started working on the CFA there.
Okay.
Worked on the CMT there. Interesting story though. My first job actually in the industry was in a boiler room.
Really?
The one right across the street from Stratton Oakmont. So it was basically boiler room and Wolf of Wall Street. Not that we did all the things that we saw in those movies.
Yes.
But the
that
environment,
was the vibe, though.
They got the environment correct on both those films, and that script is what everybody read.
Yes.
And I just this isn't for me, so I left. And then my first real firm technical analysis job was at a company called MCM Money Watch, which was bought by Informa Global Markets, and I worked there for a good 6 years.
Got it.
On their fixed income and currency products. And then I had a brief stint in fundamental research where I was a small cap equity analyst. I got the MBA at Fordham. And let's see what this is like. And I did that for a couple of years. And of course, I was working for some boutiques. And the problem with the boutiques is, we were charging 3 or 4 cents a share, and the competitors were, knocking it down to, 1 cent a share. Now it's probably free if you look at Ameritrade and a few other places,
Yeah.
And then I've been at Bank of America Merrill Lynch since 2007. So I went from the instability of these small places to big, stable Mother Merrill ahead of the financial crisis. And now I'm like, oh my God. I'm just so happy that I was able to make it through that. And so I worked under Marianne Bartels, who was, believe it or not, a lot of fun to work with. Probably the most fun I had in the industry was working with her.
That's great.
And then she moved on to the CIO office, and I moved into the Chief Equity Strategy role back in 2013.
Got it.
So I've been doing that ever since.
So where did you really learn technical analysis? How did you incorporate it? Was it from your father with what he had been doing, or was it from other places? How did you sort of get that part of it?
Well, my dad is an interesting character. He
I agree.
he did a lot of trading, but he never really was a classically trained technical analyst.
Okay, interesting.
So he looked at charts. I believe he did point and figure charts back in the 70s. He was the first long bond trader at Prudential Beige.
Oh, interesting.
So I remember being a little kid waking up, and there's a little room in one of our houses where there's this really strange looking monitor, a Telerate monitor. It's like this little box that's like 2 feet long and like a little tiny screen on it with all these numbers. It was all, I believe it was the Cantor Fitzgerald feed. So, and he used Athena Systems, Market Vision. Those are names from the past. I think Market Vision may have been looped into something else. But so what he did was he was more like the street analyst, you know what I mean? Like the guy that just learned it from experience and just listening to what other people are talking about. And I found an interest in it, and I'm like, he had his approach, but I'm like, the only way I'm going to really figure this stuff out is if I watch what he's doing. But I've also just, read on my own and learn it on my own and start studying the textbooks. And like the Edwards and McGee and the John Murphy technical analysis of the futures market, which is what it was called back
the
then.
old version,
so I guess I'm dating myself a little bit here, but and then it was really interesting because he had all the experience, but all of a sudden, I'm picking up on things he's talking about because I'm reading all the text. And then I introduced to him once. I'm like, hey, check out this. If you're looking at a longer term screen, take a look at the 200-week moving average. A lot of time you can get a cyclical bear that holds a rising 200-week moving average, and then you're off to the races again. And so he started incorporating that in his work. So
interesting.
We kind of met, in the middle with. And now he does financial engineering because he was an rambling wreck from Georgia Tech. So a lot of his stuff is mechanical,
right?
And I'm more visual, but through the years I've gotten a little bit more mechanical as well, because what I'm trying to do is cast a net that captures things I want to be looking at and avoids things I don't even want to waste my time on.
Right. So that's an interesting point. I'd love to get into your process a little bit. When I was a client of yours at Fidelity, I used to read your monthly packet every month. I thought it was really, really well done. And it strikes me as something that was super consistent. So you would look at it month to month and you would see how things evolved. And it was a great sort of take a step back moment for me, just reviewing on how things have evolved. How, can you talk about your process? I mean, how do you consume all this information? Is it in the process of writing the reports that you help formulate what you're thinking, or is there a chart reading or analytical process that helps you sort of decide how you're going to be positioned, what your outlook is? How you walk us through sort of how you get to those decisions?
Sure. I mean, so I do a combination of top down and bottoms up, and they meet somewhere in the middle. Sometimes that somewhere in the middle is more towards stock picking, where things are all dispersed, which actually has been more the current environment.
Sure.
And other times it's all right, macro. A lot of people are more focused on macro now, but I'm discovering that the macro is very confusing here. And there's every sector, even energy, which has been in a terrible downtrend for 11 years on a relative basis versus the S&P, has some stocks that don't look that bad.
That's right.
Most of them do, but some don't. And I think you're finding all those idiosyncratic moves. And the interesting thing about that, in an environment of bad macro, where you're telling these macro funds, it's like, forget about the macro, let's just focus on picking stocks. That's something interesting. But the process for me, so when I'm looking top down, it's pretty much equity index focused. I look at global advanced decline line. I look at indices, new highs, new lows, just seeing where the world is turning. It sounds like a soap opera title, but so generally speaking, we identified some interesting setups in Brazil and Russia over the last few years that have been working really well. And right now, it seems like you may actually be starting to get these massive breakouts in Europe and things like that that haven't really participated in a long time.
Sure.
And what's interesting about that is, since we work at a big firm, we've got other analysts who talk about these things from time to time, and they have sentiment data on Europe, and people are overly bullish Europe in 2000, overly bullish Europe in 2007, 2015, 2017, overly bullish. Right now, are they overly bullish? No. They're flat. They're not bearish, but they're flat.
Yeah, flat, right.
So, and also top-down indicators. I mean, I like percent of stocks about 200-day moving averages, which I think where we are in the S&P right now, we still need to get that to confirm a bit. I know some people argue with me because it's rotational, but then again, we were rotational in late 2019, rotational in early 2013 with a very similar macro backdrop, and we had confirmation. More new highs are needed. I mean, the numbers I'm looking at there to say, hey, you know what? This next rally we get on the market, which right now, early December can be choppy.
Sure.
But the next rally, I believe we can get. Once this choppiness is over, we need to get those indicators to confirm. At a minimum, at the latest, sometime in Q1.
Right.
Credit markets, option adjusted spread for high yield, benign right now. I keep that on my screen. I keep the BAA, the Treasury spread on my screen. So that's macro stuff I look at. All those are benign. From the bottoms up, I run I use weekly charts. Primarily. That's my go-to. I will look at daily and I will look at monthly. Probably look at daily more so than monthly on stocks. But the weekly is where I go and I look at a 13-week, 26, 40-week, and 200-week moving average on a chart. What I'm trying to do, and both absolute and relative. So I'm trying to bucket things in core longs where the relative and absolute are confirming on the upside, core shorts where they're confirming on the downside. And where it really gets interesting is, if you're in a bull market, you kind of, sure, that stock's rallying in an uptrend, but the relative's not confirming. So, am I going to overweight that? Probably not. It's not going to kill you, but it could generate negative alpha.
Right.
And then, on the other side is when you have a negative absolute trend and the relative starts perking up, that's where I look for new leadership.
Yeah.
And, I would argue that we're starting to see some leadership potentially from financials and industrials.
Right.
It's fits and starts. But if we're right on the call that I'm going way on here, but I just got excited about the call here.
Yeah,
the 2020 stuff. I mean, I think what we just did, a lot of people are debating whether, oh my gosh, this is a 10-year-old bull market, right?
Yeah.
But we look at the cyclical trend, we basically been pretty much flat for 2 years, similar to the way we were in 2011, 2012. I mean, obviously there were higher highs there.
Yeah.
But generally flat, and then you broke out at 13, rallied for a good 2 years plus.
Right.
Bring it to 15, 16. 2-year base, rallied for, about a year and a half or so. And here we are again, same setup. ISM went below 50. Bond yields went below 1.5. Right. And the market rallied in the face of that. So it's a wall of worry. And I think next year is where, people aren't going to be as bearish, the more neutral in terms of sentiment, but that's when the fuel starts to get into
when things can go.
Yep.
There's so much to unpack with what you just described. I'd love to hit on a couple of themes.
Sure.
But one in particular, it strikes in the introduction, you're talking about your background in fixed income, which is a little unusual. A lot of people don't have that in their experience too.
Right.
And I've always found fixed income guys or fixed income analysts tend to have a much better sense of the risk side of the equation because it's all about, planning for default and the downside. For individual investors, for investors that are not as familiar with fixed income and their understanding of fixed income is limited to the 10-year yield, what would you do? What additional data points or insights would you encourage them to draw on that would help them get a better read from the fixed income side of the sheet?
Yeah, definitely. I mean, you definitely want to focus on, I use the 2s10s yield curve. I like focusing on that one.
Yep.
We had a 1-month inversion on a monthly closing basis.
Okay.
So that was a quick inversion. We had one of those in 1998 then you had a risk rally. But that's why I watched that. And obviously we already mentioned the high yield stuff related to fixed income.
Yep.
I look at them individually across the curve because that's what I used to do when I worked at Informa.
Okay.
And just to see where everything's playing out. But I like looking at the big picture, on the macro stuff. And the funny thing is, I'm actually surprised that when you're doing fixed income markets, you always have that bearish mindset.
Sure. And
the funny thing is, this year I ignored all of that because the equity market message was just so bullish.
Yeah. Yep.
And the Fed had just overstated their tightening welcome, and then they immediately reversed that. And of course, yields are going to go down when that happens. Yeah. And everybody interpreted that as bearish. I did marketing in Europe, and they're always bearish in Europe.
Right.
For the most part, and it's like, no, your call's not going to work. Yields going down. Well, guess what? Yields kept going down. U.S. equities kept going up.
Right.
And this has been a debate that's been going on for a long time. And now I think people are generally accepting. Okay, well, rates can stay lower for longer, and the equity market can rally in the face of that.
Yeah.
So I'm lucky that I was not getting caught up in that because I remember me. Circa 2004, 2005, probably would have had a bearish view on equities based on what the bond market was doing because it's just those intermarket sort of relationships.
Yeah. You also mentioned global markets, non-U.S. equity markets, and we have a situation now where EFA's at or potentially at new highs this week. At a stronger position, Japan breaking out. So a lot of global developed markets are, but I found a lot of investors, especially institutional investors, really are not there. Like they're not trusting. The U.S. has been outperforming so consistently. It's tough to justify going outside of the U.S. How do you help your clients, or how would you encourage people to think about an international allocation? Is it time now to be thinking about it just because of the strength of those markets? Is it a dollar play, looking for strength of the dollar? How would you think about it?
Yeah, that's a great question, Dave. Yeah. I think the S&P is still leadership versus the rest of the world.
Yep.
Although it hasn't decisively gone to a new high since August. So that's interesting. It's not a straight up mover.
Yeah.
I do like the way you got big bases pretty much everywhere.
Sure.
Stocks 50, CAC 40.
Yeah.
Italy could be, and people
Yeah,
kick me out of
really?
rooms when I talk about Italy. That could be a 10-year base.
Yeah.
Spain, maybe,
Yeah.
weaker market, but, might be forming a base. And you look at, like you said, Japan, the DAX, I fit in that category too. There are two markets where they line up with what the S&P did.
Yeah.
2-year consolidation, breakout, 2013. 2-year consolidation, 2016, breakout. Both of those.
Yeah.
Doing the same thing right here, right now.
Yeah.
So it's confirming that the rally is broad. That's for sure. Now the question is, do we really overweight Europe versus the S&P at this point? And I think that is a dollar call.
Yeah.
Because when you look at the relative ratio of the U.S. versus the rest of the world, and you can't really do it with Equity ex-US. It doesn't go all the way back to when they took the dollar off the gold standard in the early 70s, but you can do it with world ex-US.
Got it.
And you can see when the dollar turns lower, usually the U.S. can lag.
Sure.
Not all the time. I mean, there's periods of time where, that relationship is delayed.
Yeah.
And right now it could actually be one of those, because when was the last peak in the dollar index? It was 2016.
That's right.
And the S&P continues to beat Equity ex-US. So
Right.
is that a divergence that suggests that if the dollar rolls over in 2020, which is debatable, but there are some scenarios you can put out there that suggest maybe the dollar does roll over next year.
Sure.
And if that happens, chances are commodities do better. And maybe it's reflationary, maybe yields go up a little bit. So that might mean that perhaps you get more cyclical performance. Maybe financials do a little bit better in these other regions, especially Europe, which has been lagging the U.S.
Sure.
But they may be double bottoming in on some of these instruments that track financials in Europe.
Right. So getting to financials, you talked earlier about U.S. markets, some leadership from financials. And, if I think of the chart of the financial sector, the XLF, this beautiful 2-year base that it's broken out. On a chart like that, which seems very constructive, what would you see that would turn you more negative, that would tell you, financials are not leadership? Is it, what would be the first thing that would come to mind? Is it more of a technical level that would be broken? Is it more of a relative strength story telling you it's other things are performing better? Would it be more of an interest rate thing? You would see interest rates do something. How would you think about financials in particular in terms of leadership, and what would tell you that that leadership is not working as expected?
Well, the way to really just cut to the core of that is that XLF versus S&P ratio.
Perfect. Yeah.
So sure, the absolute chart looks an awful lot like those past two cycles.
Yeah.
Rates would have to bounce also, I would think. ISM would have to improve. But the relative ratio of financials is the key, because what if the market gravitates towards other sectors for whatever reason on a rally?
Yeah.
So the interesting thing about that relative ratio is that it does show, a double bottom.
Yeah.
Similar to what it did in, let's think here, 2016 and 2011, 2012, where rates kept going down.
Yeah.
Financials stopped going down relative to the S&P.
Right.
Either had higher low or a matching low as yields went to lower lows. And that tells me that's where the leadership should be on the next rally.
Okay.
So if I'm wrong on that, I'm going to take my cue from that relative ratio.
Got it.
Moving back down.
Interesting. I'd love to maybe switch gears a bit and talk about some lessons learned over your career. In particular, could you give us an example of not necessarily your worst call ever, but a call that went against you, right? And just, how you dealt with that adversity. So what's an example of a time you made a call and the market didn't do it?
Sure.
How did you sort of get through that part? What did you learn from it? Those kind of things.
Well, the number one thing is always have your window to open and climb out. Jump. That's an Aunt Bernadette. Mary Ann's Aunt Bernadette. I believe one of her lessons was always have a window. Open up.
Bernadette Murphy, right?
Exactly.
Famous strategist. Murphy. Yeah.
So, which is great to have influences from people like that in your life. My dad, Mary Ann, Aunt Bernadette.
Yeah.
Yourself also. I learned some lessons from you as well.
Yep.
So, now I forgot bad call.
Yeah.
CNBC, Squawk Box, early 2016.
Okay.
Watching that pattern, watching that setup, and it looked to me like we were going to head back and retest that secular breakout point around 1575.
Right.
And sure enough, we didn't do that. So how did I immediately get bullish? It took me a little while. I said, all right, well, wait a second. Well, one thing I knew that was happening when it was that second dip in February. I was on the phone with a client, one of I can't remember who it was, but it was somebody. It might have been at your firm, actually. I can't remember who. But we were talking, and the market was down, and we're all depressed talking. And I hung up the phone with him. Actually, no. We were talking. Market was down like a ton, and then as we got off the phone, it was down like a half a ton.
Right.
And then by the close, it was like flat on the day. So I called him up. I'm like, I think our commiserating over the losses of the market pointing that bottom. But for me, when we didn't break decisively below 1,800, which would have projected down towards 1,600, the level I put on the market was quite reasonable. It's a double bottom. What would it confirm? The January and February lows of the double bottom is 1950.
Right.
So people yelled at me, oh, it's 150 points off the low. But I'm like, well, look what's happened since then,
Yeah.
I mean, sometimes you just have to, and I got more bullish before that happened. But I'm like, to confirm that, things are getting better, 1950 is the level.
Right.
So that's how I backed out of that. That was my little opening the window for that call. So I admitted that, okay, you know what? It's not a top. Something else is happening. Oh, lo and behold, look, this is looking an awful lot like what happened in 2011, 2012. That changed it.
And that played out just fine.
Yeah.
Steve, this was a fantastic discussion. Really appreciate it. Good to connect with you, my friend. Thanks for coming on.
Yep, thank you.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.